smart, I'm going to try to wrap it up really quickly. So what I'm going to discuss today will include several topics that we usually do in the first class of financial accounting. So I'm going to cover introduction to accounting and business activities and financial statements overview, balance sheet, and income statement valuation. Okay, the first slide is what is accounting. So whenever you have an operation, in order to know how your operation is going, the status of your operation and the flow, how much you make during a period of time, both are important. And both of those are the major elements of accounting, which is the balance sheet and the income statement. So I want to raise several questions. Who do you think are users of financial statements? You guys. Who? We guys? Okay. Investors, good. Debt holders? Employees, okay. What about some non-accounting majors?
Public listed companies.
Right, they have to come up with financial statements, but yeah, so managers probably use those statements to gauge how how the company is doing.
What do you call it?
CPAs?
CPA.
CPAs, okay. Okay, so we have actually people like, say, banks. Okay, banks need to look at your financial statements to decide whether they issue you loans. And then like government, they want to know if you're reporting it according to the generally accepted accounting principles. Okay, so let me see. Let's just skip the rest of the questions. Okay, so there are two types of financial statements. Well, one type is called managerial accounting, and one type is called financial accounting. So for financial accounting, the users are external users. So basically, anyone that's not within a company that needs the information is considered an external user. So for internal users, you have managers or employees. Employees may want to look at financial statements to decide if they stay with the company or move. So these are the users. Okay, let's skip to... Okay, so next I'm going to talk about the valuation rules. What kind of amounts we're going to record on the financial statements. So first, balance sheet valuation. And for balance sheet valuation, balance sheets records the historical performance of the company and gives the users a snapshot of the current status of the company. So, for example, in the balance sheet, we have cash, however much cash the company currently has. We have assets, liabilities. So those are a snapshot of the company's operations. And then so for balance sheet, the valuation is based on present value. So if you have heard about present value, basically, okay, I'm going to give you an example here. On 12/31/04, IBM borrowed $100 million from Citibank at annual interest rate at 10%. So it's a loan, it's a liability. Okay, in a year, on the last day of 2005, IBM has to repay the loan at 110. So basically, the $10 is the interest during this period. But at this date, IBM has to report on its balance sheet liability of, do you think they should report $100 or $110?
Neither.
Why?
You need to disaccount 110 to today's dollar.
Which is 100, right? They owe $100 dollars today if we look at
Okay.
12/31/04 as today. So for balance sheet, you use present value for monetary assets. Okay. For income statement valuation, we first need to understand what is income, what the income statement is composed of. So the first, how do we recognize income? When we say the company has made a certain revenue, it means, okay, the revenue has to be earned, which means most of the effort that is required for the revenue has been carried out. So for example, if you receive $100 from a customer for a computer you have to make, say Dell company, then at the time they receive that $100, they cannot recognize that as revenue. They have to, usually, for this case, they have to deliver the computer to consider that $100 income. So, okay, an example. Okay, for a company bought 10 units. Okay, this is okay, I need to actually give a little more explanation on that. Matching concept. For the income statement, we want to match expenses with revenue generating process. So for example, I want to give an example of fixed assets. For example, if a company buys a fixed assets of $1 million, and then they can use the asset for 10 years, then in that year they buy this asset, they should not consider 10 million, did I say 1 million?
1 million.
Okay, 1 million as expense, because the expense or cost of the asset is good for 10 years to generate revenue. So they need to separate that 1 million into 10 years. So each year they will record a $100,000 expense of depreciation. Okay, so I will not go into that problem now. Okay, so accrual versus cash basis income. So basically what the accounting does is accrual accounting. So basically cash basis accounting, in the example that I gave about the fixed asset, you would have to recognize $1 million expense in the year you buy the asset. That's cash-based accounting. But for accrual-based accounting, it's a better way to gauge how the company is doing, because a sudden inflow or outflow of cash flow is not a good symbol of how the company is doing. So